If someone asked you to describe Amazon, you'd probably just call it an online retailer, right? A massive digital catalog where you click a button and a box magically appears on your doorstep. But that assumption fundamentally masks one of the most sophisticated corporate architectures ever built. Welcome to a deep dive into the hidden mechanisms of a modern empire. In this explainer, we're going to challenge your basic understanding of what this company actually is, and more importantly, why it operates the way it does.
Because here's the central mystery we need to solve. How does a giant survive constant disruption? While other massive companies get completely destroyed by market shifts and bloated bureaucracy, this entity just keeps scaling. By the end of this documentary, we'll uncover the hidden systemic mechanism that makes this kind of exponential survival possible.
So let's look at that common assumption, that Amazon is just an e-commerce website. The reality? It's a dual infrastructure monopoly. Their true competitive moat isn't a digital storefront. It's a highly automated physical and digital infrastructure that pure-play retailers literally cannot duplicate. To understand how they built this impenetrable fortress, we have to look at a pivotal decision made long before the very first box was ever shipped.
It turns out the foundation of this entire empire was actually a psychological model. Back in 1994, Jeff Bezos walked away from a highly lucrative, secure Wall Street job, and he did it because of something he called his regret minimization framework. He saw the internet growing at an explosive 2,300% a year, and he viewed this not just as a passing tech trend, but as an existential pivot. For him, the emotional cost of missing out on the birth of the commercial internet simply outweighed his immediate financial security. But why start with a bookstore? Well, books were the perfect minimum viable product. Think back to early web use. It was notoriously slow, the worldwide wait, as they called it. And books didn't rely on heavy graphics to sell. They had massive worldwide demand and a low unit price that really reduced consumer risk. Plus, there were infinite unique titles. To replicate Amazon's early digital catalog, a physical store would need literally 6 football fields of physical shelf space. Books weren't the end goal. They were just a calculated test to prove that a digital database could absolutely beat the friction of physical retail.
Now, fast forward to 2025, and that initial database has scaled to a staggering $716.9 billion in consolidated net sales. And when you break that down, North American online stores still generate the bulk of that top-line revenue. That maintains the perfect illusion of a traditional retail company. But as we're about to see, that massive top-line revenue hides the real engine of the empire.
The real aha moment happens when you look at the contrast between revenue and operating margin. North American retail brought in $426 billion, but with a razor-thin 6.9% margin. Now let's look at Amazon Web Services, or AWS. Despite a much smaller revenue footprint, AWS boasts a massive 35.4% margin, generating over $45 billion in operating income. What does that mean? It means AWS is the critical cash engine that secretly subsidizes all of Amazon's low-margin retail expansion.
So how exactly do you pivot from selling paperback books to controlling the internet's core infrastructure? The answer lies in a strategy called the portfolio theory of innovation. Basically, Amazon aggressively tries to invent the next big inflection point, and they do it fully expecting that the vast majority of their attempts are going to fail.
And they really do fail. Just consider massive high-profile flops like the $17 million loss on the Fire Phone, or the recent shuttering of 68 physical retail stores. Most companies would view these as catastrophic, career-ending moves, but Amazon views them simply as the necessary cost to finding exponential successes. By accepting and even welcoming continuous experimentation, they strike those asymmetric returns, successes like AWS, Prime, and the Kindle.
Of course, to fund all these wild experiments and maintain that dual monopoly, you need capital. A lot of it. To be exact, $128.3 billion. That is the jaw-dropping amount Amazon spent on cash capital expenditures in 2025 alone. To put that into perspective, that number represents a competitive moat of such staggering scale that almost no other company on Earth can cross it.
This capital builds a practically unassailable infrastructure moat. We're talking $123 billion in liquid capital, over 741 million square feet of physical space, and proprietary custom silicon, like their Graviton and Trainium chips. They're even launching over 200 satellites for Project Cooper broadband. You'll often hear them use the phrase customer obsession as a sort of strategic shield to justify these highly dilutive, massive expenditures, which permanently lock in their dominance.
If you want to visualize the physical manifestation of this capital dominance, it can really be summed up by one incredible number: 1 million.
By 2025, Amazon had deployed over 1 million operational robots across their fulfillment centers. It's literally an army of automation.
But here's the catch. Scale almost always breeds stagnation, right? To prevent internal bureaucracy from suffocating the company, current CEO Andy Jassy maintains a culture based strictly on Jeff Bezos' original 1997 leadership principles. This philosophy ruthlessly prioritizes the present value of future cash flows over standard short-term accounting optics, and it heavily weights compensation toward company stock, making absolutely sure that employees act and think like owners.
The very core of this culture is perfectly encapsulated in this famous quote from that 1997 shareholder letter. This is day one for the internet, and if we execute well, for Amazon.com. You see, day one isn't just a catchy corporate slogan. It's a deeply ingrained cultural mechanism. It enforces perpetual urgency and an incredible willingness to dismantle perfectly working systems before they become obsolete.
So the hidden mechanism behind Amazon's survival? It's controlled, intentional instability. They completely reject comfortable, linear growth. By institutionalizing this high-pressure environment of constant structural disruption, management can execute dramatic strategic pivots without facing the kind of institutional resistance that typically destroys aging enterprises.
What does this all mean for us? Well, we can actually distill this into some incredibly practical lessons for any leader or investor. First, measure your progress by long-term cash flow, not short-term accounting optics. Second, pursue parallel paths. Launch multiple experiments at once instead of endlessly debating a single route. Third, have the courage to rebuild successful products from scratch when a major tech inflection point arrives. And finally, align your team by forcing them to think like owners.
Ultimately, to survive constant disruption, you have to embrace ambiguity. As they say, progress is nonlinear. It will zig up, stall, zag down, or force you right back to the starting line. So it leaves us with a critical question to ask ourselves. Are you building a system designed for a safe, predictable path, or a culture capable of surviving the zigzags? Because sometimes the only way forward is to intentionally go back to day one.